name is Scott Phillips. I'm the partner in charge of our National Assurance Office. Presenting with me today is Andrew Mao, who's also in the National Tax Office, and then Shelley Ersley, who's in our Technology Consulting Group. Maddie also is on the line and may participate as well. We've had a couple of presentations already for leases. Actually, we've had a series of them. We've had a few of these kind of 1 hour webinars that we've done. We've also done some A&A updates where we've covered all the new accounting and auditing guidance, but dedicated substantial time to leases because that's a hot topic. It's a complex area and one that's, although it's been put off a couple of times, it will be coming down the pipeline. And in fact, we did an A&A update earlier this year in May, and we've got another series of 3 webinars coming together later this fall where we talk about all accounting standards, but we'll dedicate substantial time to leases. For this particular webinar, we've decided to change our focus a little bit. We're not going to focus on the accounting quite so much. Again, if you have accounting questions, certainly feel free to ask those, but we've gone through the accounting quite a bit. There's been a lot of information on that. And we've talked about how everything's going to end up on the balance sheet with a right to use asset and a right to use and the lease liability. So really the focus today is, okay, how do I really get started? What's some practical ways that I can really get started, some defined steps in order to accomplish what's required of me, to get through the lease standard. And so what we've done is we got our National Assurance Office together and we collaborated along with several other experts in the field and developed what we think to be 5 sequential, defined steps where people feel like, hopefully, as you leave this, the goal would be that you have something actionable, that you know kind of where to start, or if you've already started, where to go from here. So that's probably what I'm going to cover for the next little bit. Then Shelley's going to step in and actually talk about what are some of the technology solutions and how do I know if I need a technology solution, and she's going to fill in and talk about that. And then Andrew's going to talk about some of the tax implications that come up and some things to be aware of that will also require some knowledge and information in terms of the implications of how this will affect, other aspects of the business. So with that, I'll go through these 5 steps. And this is kind of the next, 20 or 30 minutes or so to go through these steps. But the first one is identify a lease contract. That may sound simple, but we'll get into maybe some tips on how we might better do that. Also some decision points once we identify those contracts. Then we'll go through and define what the lease period is and also what the lease payments are. Those are necessary in order to actually start doing the calculation, determine what the right of use asset and the liability is. We'll talk about discount rates. In fact, and it's interesting because the guidance will be changing on that and clarifying that both for public and non-public. It's primarily impactful for the non-public, but that guidance, there's an exposure draft out that just got issued here, the last 5 or 6 weeks. That's not issued yet, but it will be shortly, and I don't expect much change there. And then determine the classification of a capital lease versus a operating lease. And the last is, what are some of the transition elections that we can make that will either make our life easier, or at least we know what we need to do. So the first step, gathering the lease, identifying all our lease contracts. And the first thing you want to do is to gather all the known contracts that you have. Now, people might think, okay, I already know where all my lease contracts are, and hopefully that's the case. But when many of these leases were sitting as operating leases, that was an area where people were managing contracts, but it wasn't always necessarily centered around the accounting, or the accounting office wasn't always in the know, and so there were variations in terms of how closely people actually tracked all that for the disclosure for operating leases. So the first thing we'll want to do is gather all those leases. The next thing, anything that's a potential lease, if you're not sure, we've had a lot of discussions with people that, well, I don't really lease a copier. I just buy the paper. I just have to pay for the usage based on the number of sheets. Well, that's a potential lease. Let's talk about that. Or it's a transportation contract. I don't really think it's a lease of an asset. I think I'm just paying for a guaranteed amount of transportation with a company. Again, those are the types of things that we want to gather, anything that's a potential lease. And then if there's been any amendments to those, if you've renewed or extended or expanded space, if you've added more equipment, you start out with 5 cars under a lease contract and you bumped it up to 7. if you start out with 5 and then you renegotiate it because you during COVID you only needed 3 instead of 5, and so you renegotiated something less. Any sort of amendment, gather all that up, put it in a single location. So again, all the leases, all the potential lease contracts, and any amendments, let's get them all in one place, because we're going to need that information in order to start assessing. In consideration of whether or not you have all the leases, as we've dealt with a lot of organizations that potentially are decentralized. When I say decentralized, I mean that in actually a couple of ways. One way you could be decentralized is you've got different departments that are managing the lease contracts versus from the accounting department. Another way is that there could be subsidiaries or affiliates, related parties that those lease contracts are sitting in different locations or are managed by different groups for different departments or geographies, or locations, subsidiaries. And so making sure that we're identifying all the different areas that might have those contracts. And as we look at that, one of the things that we can do is we can actually look at a rent or a lease expense. Let's look at that amount and let's actually reconcile that back to our contracts to make sure that all our contracts are complete. Have we identified all the contracts? And if we got some rent or lease expense coming through for which there's not a contract, let's go track that down and investigate what that expense is for. So that's one way that we can go and identify, make sure we have a completeness of our population. Another way that we've had some success is doing some sort of data mining or data analytics or some vendor searching where looking for purchases in your ledgers that are recurring vendor payments. So sometimes you might be able to find, hey, there's a recurring vendor payment the same every month. Is this a lease or not? Let's go look into this and let's investigate it. So it may or may not be sitting in your rent expense or your lease expense, but there is a recurring vendor payment that probably warrants some investigation. I've determined whether or not it's a lease. And so those are a couple of steps, hopefully, that are actionable in terms of making sure that we've identified all the contracts, particularly when, again, it could be decentralized within different departments or subsidiaries, different groups. So once we have all those contracts gathered, we're still kind of in step 1 here. Let's figure out what it is that we're leasing. Now that may seem simple at the surface. We're leasing copiers, we're leasing vehicles, we're leasing real estate. But one of the things we need to do is determine, are we leasing more than one thing? Is there kind of a package or an allocation that needs to take place? In addition to our real estate, do we also have some easements or some rights that we get with part of that package that need to be separately evaluated? Is the land, do we have more land than just a building? We have a piece of property and we have a building on it, but really there's quite a bit of land there. The land needs to be evaluated separately from the building. Is there a warehouse with a big yard on it? Is there kind of a suite of vehicles of varying degrees, sites, and sorts, as well as some larger equipment? So making sure that, okay, once we've got all the contracts, let's define, what exactly we're leasing in those contracts, and if we need to split some of those out. And then the last point here on the bottom of this slide is determining if we have non-lease components. So the lease component it's the right to use that asset, to be in that property, to have that warehouse, to use that land, that copier, that vehicle. That's the lease component, is the asset that we have a right to control for a period of use. The non-lease components, we need to evaluate if they're non-lease components. So for example, if you have a real estate lease, is included in that real estate lease maintenance for the grounds, janitorial services, anything like that that's included with that lease contract, because those have the potential to be period costs. We're going to talk a little bit more about that in a little bit. Same thing with vehicles. The vehicle, you lease a vehicle, but it actually comes with a maintenance agreement where you're required to go in and get the oil changed every 3,000 miles and have tune-ups along the way. So is there a maintenance component that in that case, it would be a period cost? It's a non-lease component that's built into that lease amount. Sometimes that's really available and transparent. Sometimes it's not. Sometimes it's clear that it's a separate component, but the price isn't allocated to that. You're just paying one fee. So there could be a little bit of work there, but let's determine, okay, of our contracts, we identified the contracts, we determined they were complete. We figured out if we were leasing more than one asset. Now do we have different components within there? Do we have some non-lease components? Again, maintenance agreements, those types of things. And then you have to identify the non-components. And this is going to be key because there's a practical expedient opportunity that we'll talk about in a few minutes about lease and non-lease components, but then have what they're considering not to be components. So taxes and insurance specifically, where there's not really a benefit or a good or service that's provided for paying taxes. That's just one of the costs. And so that needs to be separated out from the payment and it's separately expensed. Same thing with the insurance. So are there any of those that are explicitly built in where we know what the components are? So that's what we need to do in order to define the contracts. So then we get to step 2, and step 2 has a couple of components. The first one is define the lease period. The next one is define the payment. So we'll talk about that for the next couple of slides. So again, we have the contract. We determined whether or not it's a lease. We've determined that it was complete. So we have all the contracts, and we've determined whether or not there's more than one thing we're leasing and whether or not there's lease or non-lease components. So now let's start to split this up into pieces. So what is the lease period? Lease period would be the non-cancelable period plus any renewal options, minus any termination options, and then if there's any other extensions or anything else that's controlled by the lessor. So the next slide gets a little bit more detail about what this means. So when we're determining the lease option or the lease period, so we start with, let's take a real estate lease, for example. Let's say it starts out as a 5-year lease with 3 5-year renewals, so we could have it for up to 20 years. We have to determine whether or not we are going to, it's reasonably certain whether or not we would exercise those renewal options. So what goes into that consideration? First, let's define reasonably certain. 75 to 80%. We think we're 75% certain that we would renew this. Well, if you look at your projected needs, it doesn't have to be just a crystal ball guess. We can look at some extenuating factors, external factors, and making that judgment, that assessment. So we have the 5-year renewal, but we know that based on our projected needs, this is the right place for us. It fits us, it suits us, it's in the location we want, it's the size we want. And as we look out the future needs, we don't see any issue. So we think we're going to be here. So that's one consideration. Investment in leasehold improvements. Let's say you end up spending a significant amount of money on leasehold improvements on the onset. So you could pay. I've had clients that paid anywhere from several $100,000 over to even in the millions to make a space usable for their needs. And the cost of that leasehold improvement is such that there's no way they would have made that investment if they were only going to be there for 5 years. So they're totally expecting to go at least 10 to 20 years for sure. So they're reasonably certain they're going to do it just because they invested so much into it. If the termination costs are expensive, if there's a clause to get out at different points in time, but it's kind of cost prohibitive, that would be that would be a consideration. Is there business interruption to moving locations? And I've seen this actually go both ways. So if I talk about, leasehold improvement, an extensive investment on the front end. So there's an expectation that they're going to be there for an extended period of time. The location's great, it's right where they need it, those types of things. But I've also seen the other side where, okay, we needed a place to be, we needed to get downtown. This was available, but we know we're going to expand in this space is just not going to meet our needs, in the next 7 years. And so we have a 10-year lease, but we really expect by year 7, we're hoping that we'll terminate that lease and move to some bigger space. I've seen that happen, in which case, we think it's reasonably certain that we won't extend or that we will terminate actually early, or if there's early exit opportunities. So those are some of the considerations when you determine, again, is it 75 to 80% reasonably certain that we'll renew or not renew, that will terminate early, So those are some of the ways that we determine that lease period. And the last bullet point here is there is a practical expedient opportunity where if you have a short-term lease, short-term defined as with all your renewals added together, expected to be less than 12 months or less. And really what this is for is kind of those short-term equipment purchases. I mean, typically that's what happens is if you had a piece of equipment that you needed a backhoe to do a project, and you expected to have that for the next 3 months. Or you're doing a construction project, you have a crane and you expect to have it for 9 months. Even if that crosses fiscal year end, there's not a, there's not a requirement to track all those leases, but you have to make a policy election to make that clear. But again, as you gather all your leases, that's a significant decision point is, okay, for the leases that are less than 12 months, do we want to, capitalize the right to use asset and record the right to use liability or the lease liability? And if the answer is, yeah, we feel like that's important to track, then that needs to be part of this process. If you conclude that it's not, then you need to make that clear so that you can take those leases and set them aside for this purpose. So now that we've got our contracts, we know how we've defined what the period is. Now let's figure out what the payment's going to be. So we start out with our fixed payments. And my next slide, I'm going to talk a little bit about these escalation clauses, but any escalations, when we talk about those fixed payments and the escalations, sometimes it's, that includes like any sort of, consumer pricing index or any other sort of, inflationary adjustment would be included in there. I've seen situations where people had the first 6 months for free rent, and then after that, they started paying after that, and they escalated more substantially, where basically the lessor was giving them an opportunity, the lessee an opportunity to ramp up their operations. So there can be a variety of situations, but any escalations have to be included and penciled out. But again, including any sort of adjustments, including the inflationary adjustments. If there are any residual value guarantees, I normally see this more kind of in equipment and usually vehicles. We're going to lease, a truck for 2 years, but at the end of that term, we're required to guarantee what the value of that truck's going to be. So in other words, if we put extra miles on it, then the value goes down, we'll have to pay for that difference. Any non-refundable deposits that are part of the payment, any prepayments up front. This next one I want to focus on just a little bit too is, the lease incentives that the lessor pays, but the lessee owns. So if you did $500,000 with improvements in order to leasehold improvements to get into a facility, and the lessor says, you know what, I'll participate and I'll give you $100,000, and you get to keep the value of that. It's shelving, it's whatever it is, and you get to retain ownership of that improvement. Then that's actually a reduction of the consideration that you have to provide. So they've actually provided you, some consideration back. Or if the lessor, on the flip side, if you do improvements and the lessor owns those improvements, you redid the roof, you redid, all the windows or whatever, and the lessor will retain ownership of all those improvements, then that's actually part of your lease payment. That's part of the lease payment calculation. If the lessor is, if you got 6 months left or a year left on your old lease, but you're wanting to get into this facility, and the lessor says, you know what, I'll pay for some or all of that to get you out of the lease, to get you over here because you're going to lock into a 10-year with me. That's part of that. That's part of the lease payment also. That's part of that is that incentive payment. So those things can be both additions and reductions to, the total payments that you're going to make. Again, the termination costs, if you expect to terminate this, again, in my example I gave a few minutes earlier, where a lessor or a lessee is saying, yep, I entered a 10-year lease because the lessor wouldn't do it for less than 10, but I know after 7, I'm planning to be out of here because they're just not going to meet my expansion needs. Taking that, if that's what you expect, if you think it's reasonably certain, again, that 75 to 80% reasonably certain to pay that cost, then you're going to want to, then we'll include that termination cost on the schedule of all the cash outflows. If there's a purchase option at the end that we expect to be reasonably certain, 75 to 80% certain that at the end we're going to buy this piece of equipment, those purchase options are included in there. And then an initial direct costs, which I'll talk about, I think, on the next slide. So again, we're trying to find all the cash outflow. And when it comes to particularly with the lease, and any cash or non-cash inflow that's consideration of the lessor is paying on our behalf, we're trying to gather all that information to determine what our actual lease payment is over the life of this lease. And when we talk about the escalation clauses, I just want to pause and just clarify and expand on this one a little bit. Again, we talked about it includes any sort of inflationary adjustment, anything's based on an index. It does not include, certain variable payments, such as, and I see this probably more in my retail clients, but in addition to the lease, you need to pay 2% of sales or something like that. That 2% of sales would actually be a period cost. It would not be part of the lease. You don't need to estimate kind of what that's going to be unless it has a floor. So if it's, you need to pay us $10,000 a month plus 2% of sales, but no less than 50,000. So there's a floor that you know you're gonna have to pay 50,000 regardless of sales, and potentially more depending on sales. That floor would actually be included as part of your required payments because that's a guaranteed payment back to the lessor. So I just want to clarify that escalation piece. And then these initial direct costs, these do not include, if I start with the bottom, you know, kind of that bottom right corner, these do not include legal costs. They do not include costs to negotiate. Those additional costs you're paying as you're trying to evaluate the opportunities for this lease. It's actually, you know, anything that's specifically connected and direct to this lease, which the standard defines kind of two primary examples. One is commissions. The other is that, you know, a lessor could potentially be paying some incentive to terminate an old lease. Again, my example I gave a minute ago, we've got 6 months left on our lease and the lessor would like to lock us into a 10-year, so they're going to pay off the old lease for us. So those payments would not be made unless the lease is finalized. Whereas legal costs, cost to negotiate, all those things could happen and the lease could still fall through. So that's why they're not considered initial direct costs. And we're getting down kind of the final points of step 2, but so I mentioned this earlier in step 1, but there is an opportunity to combine lease and non-lease components. And you can kind of forget the GASB piece. I forgot to pull that off this slide, but for FASB, if you wanted to, you know, you said, you know what, I'm not going to bother breaking it out or trying to figure out what the non-lease components are. You know, if there's a maintenance component, janitorial component all built into the cost, and it's not apparent, maybe it's apparent on some leases, but not others. And I don't want to take the time to try and figure out what the fair value of those pieces are. You are allowed to combine those. You need to disclose that you elected that option. It does make your liability higher, so you need to be aware of that result. But in any case, that is a decision point that you need to make. Again, we talked about the residual value guarantee. You know, do we think it's more likely than not, or we think it's reasonably certain that we're going to use this past what is part of the contract, and we're going to have to make up some difference on residual value guarantee. And we talked about, you know, as you sketch out all the leases and all the renewal options, the termination clauses, is it reasonably certain that we're going to exercise these options or terminate these? And then evaluate whether or not you have different lease components, and there is an opportunity to combine certain things such as land or easements with building. There's some opportunities there. So those are some of the things that you would need to, some decision points you need to evaluate as you're determining, you know, how to allocate that lease. All right, let's talk about discount rates for a minute. So we've got the contracts lined out, we've identified our leases, we've figured out what the lease term is, we've determined what the lease payments are. So how do we present value that cash flow back? This is where the standard is clarifying and changing. And this is an exposure draft, but not issued yet, but it will be soon. The first is, if there's an implicit rate under the lease, if we can determine what the implicit rate is, you are required to use that on any given lease, any individual lease. That was a little unclear before whether or not that was expected, required. If you chose to use incremental borrowing rate, would that circumvent using, should you only choose one or the other? And so the FASB wanted to clarify that, no, we expect that on any individual lease, if you know what the implicit rate is, or you can calculate, you know, what it basically says is if it's reasonably determinable. So if you can reasonably determine what the implicit rate is, then you should use that rate on that lease. The next piece that was a little, you know, had some varying complexities to it is, should you use the incremental borrowing rate, or in the case of non-publics, they also had an opportunity to use a risk-free rate. The benefit of using the risk-free rate is it's simple to determine, but the downside is that it's usually a small rate, and so using a smaller discount rate will make your lease liability larger. On the incremental borrowing rate, I've got the next slide talks a little bit about that. Where the clarification is coming is, before with the risk-free rate, if a non-public company chose to use the risk-free rate, it had to be kind of an entity-wide, all lease type consideration, kind of an all or nothing. You're either going to use it, you can't really pick and choose. Other than, again, the implicit rate piece was a little uncertain in that context. So, but now what they're saying is you can actually use that for classes of assets. So if you said, you know what, we're going to use the incremental borrowing rate for all of our real estate leases because we think we can determine that. But for all of our equipment leases, we're going to use a risk-free rate. You could actually do it by class. I need to be consistent on which of those rates you use, but you can't do it by class. So again, if I recap, implicit rate, if it's reasonably determinable, should be used on any individual lease. And then the other leases should be put into classes, real estate, equipment, land, and then determine whether or not to apply the incremental borrowing rate or the risk-free rate to any of those given classes. When it comes to the incremental borrowing rate, the clarification I want to put out there is that this is summarized from the guidance, but collateralized basis over short term or by similar terms and similar economic environments. So in other words, what that means is that you shouldn't take, if you had a uncollateralized line of credit, that is probably not the appropriate rate to then apply to your leases because your leases are all collateralized by the underlying assets. If you had long-term borrowing, that might translate, be a good starting point to determine incremental borrowing rate for your real estate leases if they're 10 or 20 years and you've got long-term borrowing over that same period. But it's probably not appropriate starting point to determine incremental borrowing rate for your equipment. By the same token, if you've got a collateralized line of credit that's short-term, that may be a starting point to determine the incremental borrowing rate for the equipment, but probably doesn't apply to your long-term, if you have a 20-year lease arrangement with real estate. So again, a collateralized basis with similar terms and similar economic considerations. So the decision can be, do we want to use the risk-free rate across all the classes of assets or certain classes of assets? And if it's only certain classes, then determining that what's the proper incremental borrowing rate for the other classes? Again, collateralized over similar terms and economic. So two more pieces of information to gather. And really, it's probably one is simple and one's a little more work. Once we've gathered all this information, now we start doing calculations. We determine whether or not we have a financing lease or an operating lease. And these are the 5 criteria. It used to be 4 for a capital lease. Capital lease is now called financing lease. They've taken away a couple of the bright lines. So let me kind of walk through these. When you look at the contract, ownership will transfer at the end of the lease term, you're in a financing lease. If you're reasonably certain that you're going to exercise a purchase option at the end, you're in a financing lease. If the lease term is a major part of the remaining economic life of the asset, then you're in a financing lease. And what it used to say, if you're going to use it for 75% of the useful life. Well, now they use 75% is still there, but as a guideline, not as a bright line. So, I'd had situations where clients are like, well, it's going to be 70% of the life. It's less than 75, and that was a bright line test before. So it was not a financing or a capital lease because it was less than 75. Well, now if you're sitting at 70, 72, 73, while 75 it's a guideline, if you're close to that number, you're probably in a capital lease or a financing lease situation. And then similarly with this point 4, when it talks about, is the fair value of the future lease payments, there's the discounted value of the future lease payments greater than the fair value of the asset. Before it was a bright line 90%. Now it's a guideline 90%. And I have plenty of situations where we did the work, we did the math, we felt comfortable with the assumptions. It came out to be 88, 89, 87. And we determined black and white that was an operating lease. Now you still might be in a financing lease situation. Again, it's a guideline. And this is the additional piece of information you'd need to gather is what's the fair value of that asset so that you can determine whether or not it's a financing lease. So that'll be some additional information needs to be gathered. And then the last one is, is the asset so specialized in nature there's not an alternative use? I've actually had this come up several times with clients, and really where it boils down to is, I've had clients that have entered into an arrangement where they had a piece of equipment or a facility, part of a facility that was built that was actually customized to their specific needs, but they did it under the arrangement of a lease. But it was so specialized that there wasn't really an alternative use for that. So, and in some cases, those really ended up being operating leases based on the previous criteria. But under the new criteria, if it's really a customized piece of equipment, or I've seen it in facilities too, even part of a building is customized, such there's not really an alternative use without a lot of work of tearing it back apart, then that would be a financing lease. So rounding out my last couple of slides here, the next decision is the guidance does allow when this first year of adoption, you can apply to all periods presented. So you have a comparative financial statement. Do we need to figure all this out as of 2021? Or if it's not or do we only want to figure it out for the year of adoption, which would be calendar year 2022? At least that's the current effective date. So another decision to make is, when are we going to apply this? All periods presented, or just the year of adoption? And the last piece here is there's a series of practical expedients that say if you already determined that something is not a lease, you don't have to reassess it. If you already determined something was a capital versus an operating lease, you don't need to reassess. If you've already determined initial direct costs one way or another, you don't have to reassess in the year of adoption. Now, if you conclude that there was an error before, you do have to correct that error, but you're not required to go looking for reassessing where it would fall under the new criteria. And then the last one is that you are allowed to use hindsight. So you can look back and go, yep, we entered into this lease 15 years ago, and we already know that we've done renewal options, and we modified the lease to extend the lease terms. And so you can actually use hindsight for that. You don't have to go back to lease inception and say, what would you have thought, back in 2006 when we entered into this arrangement, what would we have thought then? You can actually use hindsight. So again, this is effective now. The dates have changed a few times. Public companies it's already effective for, but for non-publics, it's effective for 2022. Often when we do these, we often when the standards have come about, people kind of wait till the end and then they try to get it together. This is not one that you can wait till after the first quarter of 2023 and try to gather the information. This has got much more involvement to it, a lot of decisions that need to be made. So make sure that you're starting now to gather this information. All right, with that, I'll turn it over to Shelly, and she'll kind of walk us through, okay, as we're doing this evaluation, what are some of the considerations we have for software and other things.
Thank you, Scott. So as you look at planning for implementing this particular standard, you really have three options as to how you're going to track your lease activity. You can take the approach of there is specific software that is designed, we call it purpose-built software, that is designed to help you through this process and manage it from an internal perspective. There's the Excel spreadsheet, which is good, and obviously we're all very comfortable with that, but it may not be the best solution based on what your environment is like, the volume of leases and such, which we'll talk about. And then there's the third option, which is outsourcing. So similar to maybe you outsource payroll, bill pay, those sorts of things. Outsourcing this lease administration to organizations that do this and have the staff and the expertise available if you have a large volume of leases might be an option for you. So as we talk about these options, I think you will see that each one of them is a viable option. Some are going to fit your organization and your needs better than others. And as we go through this, think about how this might apply as you're planning for your lease implementation. Lease administration and accounting software really has a lot of positives if in certain situations. Typically, as you can imagine, this software would be used if you have a large volume of leases that you are managing. Other reasons to use software is, it's designed specifically for this purpose, to be able to track and maintain and to automate your calculations and your journal entry prep. And it has the controls in place to do that for you. So having that audit trail of any changes, as you can imagine, and you've experienced before, when you're utilizing an Excel spreadsheet, there's some risk associated with that, especially if you have a large volume, a number of people with their hands in there making changes and keeping it up to date. And so a software that is built for this tracking and administration may be a good choice for you. Other reasons that you might consider utilizing a software package is it may integrate with your existing ERP or accounting solution. So some of the solutions out there today have partnered with or even built on some additional functionality that integrates specifically with their system. And so there may be a nice easy integration point there to explore. Other reasons that you might utilize a software like this, and maybe it's one of the things that, especially in today's times with staff shortages and just people being quite busy, if your staff, if you have staff available that can learn a system and utilize it and manage it, especially for a large volume of leases, a software like this would be very helpful and useful to you. The other option, or one of the other options, is an Excel spreadsheet. And for those of you who may have a very limited number of leases, it's easy to administer and account for those leases within Excel to make your decisions to keep it up to date. You might utilize a spreadsheet if you have one or two people who are tracking this. So the risk of changes and things is very manageable. Some of the benefits, obviously, of Excel, you're not buying another package software that someone has to learn and maintain, and it doesn't require any IT or vendor support if you're doing this, utilizing an Excel spreadsheet. Sometimes people will ask us, so what's the magic number of leases where you kind of have that decision to make of, should we continue to try to utilize Excel and manage it through there, or should we utilize a software built for this? And I think you'll find that the number is lower than maybe what you're thinking today. We've really heard anywhere between 15 and 20 leases is really, kind of the optimal. Something below that is optimal for Excel. I think what people are finding is, as you get more into this and you start evaluating and making these decisions, it gets very cumbersome in an Excel spreadsheet. And so just something to consider there. And then option 3 is outsourcing. So outsourcing this sort of administration to an organization who has the staff to do this work for you. It really shifts the work and the responsibilities from your existing staff so that they're spending their time on reviewing the results, looking at the entries, reviewing and approving those. And they're not spending time on the detailed data entry and time within the software or within a spreadsheet, however they may do that. This outsourcing is also a good way to kind of reduce some risk by utilizing partners who have subject matter expertise, who can help you through some of the, the advice and guidance and helping through those decisions, not making those decisions for you, but really helping guide you. And they have numerous staff who have that knowledge. Whereas if you were doing this in-house, you may have just 1 or 2 people who would be your experts, and there's always risk associated with that. And then, of course, it does, eliminate the need to find software, to go spend that time and get new software implemented. Although I would tell you that the lease administration and accounting software that has come onto the market in support of this is relatively easy to use and easy to get stood up. So, while all of these are great options, you have to pick the one that is right for you. The most important decision criteria as you're looking at where do I go? Which of these three options is best for me? Think about what's best for your environment, your staff. What are their priorities today? Do they have the workload, availability to take on more, to learn this, to start working through this? But also your volume of leases is a really big factor as well. So with that, we will turn it over to Andrea, who will talk about some of the tax considerations.
All right.
And I'm just going to jump in real quick. Sorry to interrupt, but I was working with a team that had was helping a client through implementation, and they had about 7 or 8 leases, so not a lot of leases. And they've opted based on the limited number of leases to use Excel. What they're finding is actually, even with that limited number, to create 7 or 8 different amortization schedules, compile them into one amortization schedule, risks of formulas being wrong. And then when there's modifications, that modification, if you were mid-year in a modification to extend a lease or expand space or whatever it is, those should change your entries as of that modification date. And so they were finding that also became difficult to track a change midstream, whereas the softwares are meant to track and calculate entries. So not saying you shouldn't do that, but just thought it was worth kind of offering kind of an observation that we've had recently, that even a limited number, like that 7 or 8, became much more involved with more risks of errors than what anybody was expecting. So just thought it was worth kind of throwing out there. So
thank you for that example.
Well, now we're on to what I think is the exciting part of this presentation, discussing some of the tax considerations around leasing. And today I just wanted to draw attention to 2 of the areas where I see the most client questions or issues arise, and how that can align a little bit with the process that Scott and Shelley have been talking about with the new GAAP leasing standards. The tax rules have not changed. Nothing is new on our side of the universe. However, because we're going through the work of reviewing these leases, analyzing them, summarizing terms, there are some things from a tax perspective that we should be considering at this point. One of the first big issues I see is the actual classification of the transaction for tax purposes. Scott started out today talking about how do you identify leases for financial reporting purposes. We have a similar exercise on the tax side. One of the big differences between tax and financial reporting is the terminology that we use. Scott's going to talk about, he used to talk about capital leases, and now they're financing leases versus operating leases. In our world, there's really only leases and sales. So transactions that are not classified as true leases, i.e. a situation where a lessor owns a property, a lessee pays for the right to use it, the lessor retains ownership throughout the term of the arrangement, that is a lease. Everything else where the ownership is transferred to the lessee gets more than just the right to use the asset. Those are typically treated as either sales or financing transactions for tax purposes. So that can get a lot of people confused off the bat, because the way we think about these transactions changes significantly depending on whether they're considered a true or an operating lease. And from a tax perspective, the lifetime income of the lessor and the lessee is going to be the same, regardless of how we classify the transaction, whether it's a lease with rental income and rent expense, or it's a sale that has an interest component and principal recovery. We're going to get to the same end taxable income number. However, the timing of those taxable income and expense items will change significantly depending on whether this is a lease or a financing/sale transaction. One of the biggest areas is depreciation. For tax purposes, we have accelerated depreciation on all equipment, and even some types of now land improvements and leasehold improvements and things that can significantly accelerate the deductions for the party that is deemed to be the owner of those assets for tax purposes. So there can be a very significant cash tax savings or cash tax cost depending on which side of this transaction you are. And then as Scott said earlier, a lot of the exercise here, he and Shelley talked about all of the data points and how do you organize this, all of the information that they are collecting for purposes of implementing ASC 842 is beneficial to us on the tax side. that is the same information that we are going to use largely to classify the transaction for tax purposes. So we have a very unique opportunity here to take advantage of some work that they're already doing that we can pull into our tax analysis and try to improve our tax processes. The second area where I see a lot of issues on the tax side are leases that have either increasing or decreasing rents. So leases where start out at $10 per square foot, increasing by 3% every year for the first 5 years, and then 5% for the following years. Or some cases it's the opposite. You start at X and go X minus 2%, X minus 3%. We have some very different rules for recognizing the rental income and expense from those agreements than they do on the financial reporting side. So we often have book tax differences or Schedule M adjustments that we should be seeing on these types of lease agreements. And those can, again, be a very significant difference in timing as to when that expense or income is recognized, tax versus GAAP, that unfortunately do not always get caught. The first issue, as I talked about, was tax classification. From our perspective, this is a facts and circumstances analysis, similar to what Scott was saying. Our key factor really that the IRS is trying to identify is which party has the benefits and burdens of ownership of the property, i.e. who's really benefiting or who's really bearing the cost of this asset. During the term of the lease and following the lease, who really is carrying the opportunity to benefit or the risk that something will go south. And similar, Scott was talking about a multi-factor test. We have the same situation. We have a lot of factors we're going to look at. Unfortunately, from our perspective, no one factor is necessarily going to get us the answer. And like Scott said, they removed some of their bright line tests, but for us, we really need to look at, in this case, all 6 of these items and weigh them against each other. Just because one of them is indicating it's a lease doesn't mean we can stop our analysis, or just because one of these factors indicates that it could be considered a sale, do we stop our analysis? We still unfortunately need to balance all of these items. And so these are data points that hopefully we will be able to identify or at least improve the ability to gather some of this information if we can leverage what the financial reporting team is doing. And some of these factors are very similar to the types of things that Scott talked about, just with a little bit of a different tax twist. For example, Scott talked about, is the purchase option likely to be exercised? Well, from our perspective, we're going to look at that from an economic standpoint. Generally speaking, if that is at a fair market value, so if my cost at the end of a lease is to buy the asset that I've been using is fair market value, I'm probably not going to be considered the owner of that asset until I exercise that option. However, if it is far less than fair market value, it's $1, it's $100, it's $1,000 on a piece of equipment that's worth tens of thousands of dollars, that's more likely to deem me to be the owner of that equipment. So then it is more likely to be a sale or financing transaction than it is if it is a fair market value option. We're also going to consider the length of the lease. Is there any, when this lease is over, is there anything left for the lessor? Is there an opportunity for them to benefit? And even in some cases, that may just be the whatever remaining residual value, even if it isn't a lot. If that belongs to the lessor, that could result in the transaction being treated as a lease rather than a financing transaction. So, as I said, it's going to parallel in some ways the types of analysis that's being done on the financial reporting side, but we will get different answers. And I think in my experience, it is not uncommon at all to get different answers. I mean, possibly even in the realm of close to half of leases will have different classifications for book purposes and tax purposes, just based on the different analysis and the way that the factors are applied. We can get to a very different answer than Scott's team can, which, as I said earlier, unfortunately can create a significant difference in when these income and expense items are coming in, and then can create a very significant exposure item in the event that we are accelerating deductions that we shouldn't be accelerating, or we're deferring income that we shouldn't be deferring. We've unfortunately seen this issue come up a couple times on exam, and it can be unpleasant discussion with the IRS. And the second issue I mentioned earlier are the leases that have increasing or decreasing rents or deferred or prepaid rents. We call these Section 467 lease agreements because, as you might have guessed, that is the section in the Internal Revenue Code that lays out the rules for these leases. And there are regulations under Section 467, but I wouldn't recommend reading them unless you really, really enjoy tax, because they will give almost any experienced tax practitioner a headache. They give me a headache. I do try not to read them as much as I can, but I can't get away with that, unfortunately. And the issue with the 467 leases are generally, again, it's timing. When am I recognizing the lease income and lease expense? So for example, in an increasing rent situation where the rent is stepped up 3% each year, often what we'll see happen on the financial reporting side is they'll straight line that rent over the term of the lease. So you have the exact same rental income, same rental expense over the term of the lease. That might be the answer for tax purposes, but frequently it is not. Section 467 provides 3 different possible methods that may need to be applied. And the straight line method is the most severe. It only comes into play when we have a very significant, even what the IRS would consider to be a tax avoidance type situation. So it is not common that we are using a straight line method on the tax side, meaning that typically, again, we should be seeing a book tax difference anytime we have a straight line lease payment with a, your deferred rent asset or liability on the balance sheet. We probably need to consider the possibility that we have a book tax difference on that. There are also some rules that will result in reclassifying pieces of that lease income and expense as interest, which is interest for all purposes of the code, including our new friend, the 163J interest expense limitations. So this can be a pro or a con. You can generate interest income on some of these transactions, but you can also generate additional interest expense that does need to be respected as interest expense for tax purposes. And the other thing we've seen a lot of over the last year are COVID-related lease modifications. We are generally required for tax purposes to analyze the lease and the potential application of 467 at the outset. And then anytime the lease is modified after that, we need to go through our 467 analysis again. So what we've seen happen with COVID is there were a lot of lease modifications that occurred for COVID. There were rent abatement periods, there were delays in rent payments, there were cancellation costs, there were all sorts of modifications that were made to lease agreements that can result in some of the rent being considered either deferred or prepaid. The IRS defines deferred or prepaid rent as a situation where the rent is allocated to a different period that it is payable. So for example, on the last bullet point here, and I have seen several leases where this has happened in COVID, they have said, all right, your rent for March of 2020 to September of 2020, so for that 6-month period, you don't need to pay me that until September 21. So September of 2021. The issue though is that that rent is still allocated to the period in 2020, even though it isn't payable until 2021. And I think there are various reasons people chose to use that language, likely one of which was it kept your claim alive. If the rent didn't fix until 2021 and someone were to go bankrupt or run into some financial problems in the meantime, you might lose your ability to collect that rent. So they left the rent as earned in the earlier year, but payable in the second year, which created a lot of new 467 lease agreements. And all of those modifications, again, need to be analyzed. Typically, where we see a deferral period of maybe only a few months, the impact on the lease accounting is limited. However, if it is more than a year, we can get some very unpleasant and unexpected results, especially for cash basis taxpayers. Cash basis taxpayers don't get to avoid any of this analysis, so they may end up in a position where they're required to accrue this rent without actually receiving any cash, which is sort of the worst case scenario in the tax world, is to have a tax liability with no cash coming in to use to pay it. The other thing we've seen during COVID was just the rent forgiveness. Hey, you know what? Don't pay rent for the summer, or we'll give you March to June with no rent because you were closed for those 3 months. That again is considered to be sort of like a rent holiday. And often, on the gap sides, that will result in rent being straight line. That can change the accruals there. So we need to make sure we're catching those on the tax side, because a lease that maybe didn't have straight line rent before may now, because of a holiday period like that. The good news is that if we do identify a lease that has been accounted for incorrectly, we can file an accounting method change for tax purposes. It is an automatic change, so it can be filed with the timely filed return. And if there is an unfavorable adjustment, additional income required as a result of this change, we can spread that over 4 years. Or if it's favorable, we can deduct that in full in the year that we make the change. So don't panic. If it's not working correctly right now, we can very easily fix that on the tax side. And with that, do we have any questions that have other questions?
I haven't seen, I mean, we've had a few that have come up through the Q&A and I've answered those along the way. So I haven't seen anything else come up, but if anybody has any other questions, don't hesitate to reach out to us.